Hello, I'm Fred Eames, partner at Hunton & Williams. It's my great pleasure to welcome you to the Utility Sector Carbon Regulation and Innovation webinar. Before we begin, let me first note that this event is in listen-only mode and is being recorded. Please feel free to message any questions you may have throughout the program by selecting the chat icon in the Ready Talk toolbar. Time permitting, we will answer your questions at the completion of today's presentation. If we do not get to your question, someone will follow up with you by email. The future of electric generation is being shaped by carbon dioxide regulation, which is currently in an uncertain posture. On the heels of the historic Paris Agreement, the Clean Power Plan, centerpiece of U.S. carbon reduction policy, has been stayed by the Supreme Court. Moreover, meaningful carbon reductions cannot be made without deployment of carbon capture, utilization, and storage technology, CCUS, a technology that may generate new wealth as it captures emissions. Today we'll discuss the future U.S. carbon policy and how CCUS technology is central both to the future of fossil fuels and to meeting climate reduction targets. Today's webinar will feature Terry Smith, CEO of Smith's Research and Grading, who will brief us about his global infrastructure assessment and the critical need to address political event risk using carbon capture technology. Tawna Szymanski, Senior Associate at Hunton & Williams, who will cover the carbon dioxide regulatory landscape. Dan Aschenbach, Senior Vice President, Global Project and Infrastructure Finance, Moody's Investors Service, will be discussing investment requirements. Our panel on generation needs and investment will include Dan as moderator, and the panel will include Randy Girardis, Director of Municipal Securities Research for Wells Fargo Securities, Paula Gold-Williams, Interim President and CEO of CPS Energy in San Antonio, and Pat Pope, CEO of Nebraska Public Power District. I will then make a presentation on generation fleet changes and be followed by Mike Moore, Vice President at Fern Oil, who will present on environmental imperatives and financial opportunities surrounding CCUS. So first up, I'd like to introduce Terry Smith, CEO of Smith's Research and Grading.
Thanks, Fred. Someone could have. Someone should have. Someone did connect the dots. Smith's Research and Grading was the first, and for many years the only source of comprehensive critical infrastructure assessments for the United States and later around the globe. Next slide. It started in 1992 with the municipal bond market. As you can see, there's a $3.7 trillion present value assigned to the municipal debt outstanding. We've tracked 65,000 municipal entities that are potential issuers of municipal bonds, but only about 15,000 currently have issued debt. We have the 50 states. There are 3,000 public power utilities, including the investor owns. We also track the transmission systems, the power purchase agreements. We have 2,000 public hospitals, including the VA system, 700 nursing homes, 50 seaports. And we go well beyond the municipal bond market because if you see the 50 seaports there, we look at the ports of entry. There are over 100 ports of entry that we track, but only 50 have benefited from the use of municipal bonds. There's an opportunity there. And next slide. Around the globe, we look at places like the portfolios of the IMF, the Asian Development Bank, the World Bank, by source and use to track the critical infrastructure. We look at 192 member countries in the United Nations, and we assign sovereign risk ratings to those. We track things. We have a 17,000 dam database here in the United States, plus we have dams like in Ethiopia, where the Blue Nile River project is going, a potential game changer for countries in Africa and the Middle East. We track the Five Gorges Dam in China, other places, India, Nepal, desalinization plants in Saudi Arabia and Libya with hundreds of millions of dollars perhaps wasted there in Libya, new dry docks in Iran and the United Arab Emirates. We look at strategic lines of communications like the Panama Canal, Suez Canal, Strait of Hormuz, and those submarine cables, including the dark fiber. We look at new technology transfer risks, such as the air-independent propulsion that's being used developed in Germany and Sweden, being used by Japan, Australia, India, now Pakistan, and South Korea, These are particularly stealthy technologies. It's a poor man's sort of strategic weapon, and they are very, very good at eluding our gliders, these underwater drones that we've developed. Next slide. Smith's critical infrastructure assessment as practice today is going to focus on this mission that we all share to protect and preserve the uninterrupted supply of power in the United States. Smith's scenario event risk analysis found that the nationalized entities around the globe are manipulating the price of oil and commodity prices. As you know, outside the United States, many countries have nationalized their energy. We also have political event risk disruption here in the United States because our energy policy is very disjoint. And we have Hunt and Williams today to help us understand better and allow us, I don't think anybody on this phone call is against clean air, but we need to be able to invest and be able to recover our investment over the useful life of the assets. And that way we can have access to the capital markets. And finally, I think we've identified state or terrorist-sponsored attacks on strategic lines of communication that are potential disruptors to the supply of energy and fuel. You'll see from the chart associated there, you'll see that we have a Russian mobile launch there, mobile rocket launcher. And as you can see, if it moves a little bit west, if they can move a little bit west, that would basically seal off the Bosporus. Turkey, of course, has threatened to seal off the Bosporus as part of its negotiations with Russia and Syria. But Russia being able to do that to Turkey would be turn the tables. So Smith's critical infrastructure assessment is scenario-driven event risks underscore a need to develop carbon capture to ensure public power supply can include coal as part of its energy basket going forward. Next slide. This is a picture of the Middle East right now. We've got Syria, Iraq, and Turkey there. And I wanted to underscore that this is an area where there's lots of intersections of the supply lines. And I think what's not shown on here, of course, is Basra, which is down south. That's where a lot of our, the economic henchmen, the people that are actually building and supplying the port there, are selling their homes. They're selling their restaurants where they brought their chefs in. They're closing schools. They're getting out of Dodge. It's boomtown economics in reverse. And it's something that's compelling in thinking about the pressure that it puts on people, nation states, to address the problem of the lower oil prices. And that's why I say that we have a critical need potentially right now. It could happen any moment. Certainly looking over the horizon, the state-sponsored or terrorist activities could threaten that, and we need to be able to ensure that coal, which is a strategic reserve for the United States, remains a viable economic alternative. Next slide. Mike Moore spoke at Smith's High Yield Conference in Greenwich last year, and he brought up this idea of the carbon capture, storage, and utilization, which I had no idea what that meant. And so this is just a little picture. I'm sure we're going to learn a lot more from Fred and from Mike about what that involves. But as you can see, there's the power plant. Somehow this CO2 is captured and used to be put into the ground in this instance. And we'll learn more about how that can help with the recovery of oil and other assets. So Smith's critical infrastructure assessments, next slide, found a compelling case to work together with Hunt and Williams, Moody's Investor Service, and Wells Fargo Securities, and all the people on this call. We share one tomorrow. Together we can work as one team to build a better world. So I'd like to turn it back now to Hunt and Williams.
Thank you, Terry. Next we have Tana Szymanski to present regarding the regulatory front.
Thank you, Fred. So I've been asked to provide a sort of set the stage for the rest of the discussion by providing a fairly high-level overview of the new power plant carbon dioxide rules that were issued last summer. I'll talk a little bit about their status, the litigation, and then we'll move on from there, the rest of the discussion. So as I'm sure everyone knows on the call, last August, the EPA administrator signed a suite of 3 different regulations These were all published in the Federal Register at the end of October, on October 23rd. The first is a final rule that governs carbon dioxide emissions from new, modified, and reconstructed electric generating units. The second is a final rule governing carbon dioxide emissions from existing electric generating units. And the third is a proposed rule that is sort of a companion piece to the Section 111D rule, which is also known as the Clean Power Plan. Before getting into the rules, I'm going to just step back a bit and just cover a little bit about the statute on which these rules are based. These all were passed under Section 111 of the Clean Air Act. And that section is a provision of Title I, which governs stationary sources, that provides for standards of performance for stationary sources. And I've included in the slide the definition from the Clean Air Act. It's Section 111A1. And I do that just because that definition really is at the heart of a lot of the legal arguments that are in play right now in the litigation challenging both the Section 111B and Section 111D rules in the D.C. Circuit Court of Appeals right now. I've underlined sort of the parts of the definition that are really central to a lot of the legal arguments. But pretty much every single word in that definition has come up in the litigation so far. The underlined ones regarding whether an emission limitation is achievable by the regulated sources, whether EPA properly applied and established and selected a best system of emission reduction for sources, whether it properly took into account the cost of achieving such reductions, and whether that best system of emission reduction is adequately demonstrated. So these are all at the heart of a number of the legal arguments that are being made by petitioners in the litigation. The same definition of standard performance applies to both Section 111B, which governs new and modified sources, and Section 111D, even though the structure of those two provisions generally, the way EPA goes about regulating those two different types of sources is very different. So under B, EPA really has a very central role in establishing the emission standards for new and modified and reconstructed sources. Under Section 111D, it establishes guidelines and then states actually set the standards. So there's a somewhat different structure between B and D, but at base, what the standard of performance is and how that's defined, that identical definition applies to both provisions of the Act. So just getting into a little bit about what those standards are, I have tables in the next couple of slides for what the rates are that EPA established for new, modified, and reconstructed coal-fired electric generating units. And I've compared them to what EPA had proposed. And just to note, too, EPA actually issued two proposed rules, and a lot of people have probably forgotten this at this point, but I think the first proposal came out in 2012, and then it was withdrawn, and then we had a second proposal in 2014, and then, of course, it was finalized last summer. So in essence, the rates, the standard for any new coal-fired electric generating unit in the United States is a 1,400 pound of CO2 per megawatt hour rate. In other words, no new coal-fired electric generating unit can emit at a rate that is higher than that rate. The best system of emission reduction on which that rate is based, according to EPA, is a highly efficient, supercritical pulverized coal boiler using post-combustion partial capture and storage. And the rates are 16% for bituminous coal and 22% for other types of coal. For modified coal units, EPA established a standard that is the unit's best annual rate since 2002, and there's a floor which reflects the rate that EPA established for reconstructed units. And the BSER that EPA established to set that rate was the unit's best potential performance as determined by that source's best historical performance. And then for the reconstructed coal-fired EGUs, the standard is 1,800 pounds of CO2 per megawatt hour if you're a large unit, or 2,000 pounds of CO2 per megawatt hour if you're a smaller unit. And the BSCR for that is the use of the most efficient generating technology. For new and reconstructed gas-fired combustion turbines, the standard is 1,000 pounds of CO2 per megawatt hour for baseload units, and for non-baseload units, it's a MMBTU rate. And the BSCR for that is based on modern, efficient natural gas combined cycle technology. So getting into the Clean Power Plan, the rule under Section 111D of the Clean Air Act that EPA finalized in October. The standard, so again, EPA doesn't technically set the standards for existing units under 111D. It sets what it calls an emission guideline, and states are supposed to use those guidelines to set standards for each source within their states. So for the guidelines, EPA set what it calls nationally uniform CO2 emission rates, and for coal units, that rate is 1305 pounds of CO2 per megawatt hour, and for gas units, it's 771. So you'll recall just a slide or two ago that the rate for the standard for new coal units is 1,400 pounds of CO2 per megawatt hour, and that is based on the assumption that new units will be using partial CCS to achieve that rate. Here, the rate is much more stringent, well, slightly more stringent, I suppose, than the new source rate, and that, of course, has been an issue in the litigation. And then also for gas-fired turbines, it's 771 as compared to 1,000 for the new units. EPA also establishes state goals that range between these two rates, and that's based on the weighted average of the existing profile of fossil electric generation in the state. And then it establishes some equivalent mass-based goals in short tons. So the reason this maybe is counterintuitive is that EPA took a very different approach with this rule than it has with other Section 111 rules. So instead of establishing a best system of emission reduction for an individual electric generating unit, which it has done in the past for both existing and new source rules under Section 111, it essentially established a best system of emission reduction for the entire source category, including sources that are actually outside the source category, including renewable facilities. So the source category, again, is fossil fuel-fired electric generating units. It doesn't include renewable facilities, but EPA established this very unusual best system of emission reduction, which assumes a generation shifting from coal units to gas units, and then also from both coal and gas units to renewable facilities. And using that best system of emission reduction for the entire electric generating industry, it came up with these numbers that it said would be achievable. And it says these are achievable because units can sort of work together either in an emissions trading system or through direct investment to facilitate this type of generation shifting. So a little bit on the litigation. As everyone I'm sure is aware, as soon as those rules were published in the Federal Register, petitions for review were filed. In fact, they were filed pretty much the minute the clerk's office opened at the U.S. Court of Appeals for the DC Circuit. The attention was really focused on the Clean Power Plan and has been all along, although a number of petitioners actually did file petitions for review on the 111B rule as well on that very first day. In the Clean Power Plan litigation, we have 157 different petitioners, including 27 states. Also on the very first day, a number of motions to stay that rule were filed. And that's very unusual. You do see motions to stay rules on occasion, but rarely do you see them being filed on the very, very first day before the dockets are even open for that rule. So that was a huge effort combined, a number of industry groups combined together to file those motions. The DC Circuit denied those stays in late January. But at the time they denied the stays, they expedited the briefing, and that is something that petitioners had requested. States in particular were urging the court to ensure that that the litigation concluded relatively quickly because of this very accelerated timeline that EPA had set forward for establishing state plans. Not long after the D.C. Circuit denied the stay, a number of petitioners went ahead and filed applications with the Supreme Court to stay the rule, and those, in a very unprecedented move, were actually granted on February 9th. The briefing in that case is concluding shortly. The final reply briefs are due next Friday, and oral argument will be on June 2nd and possibly June 3rd, 2016. The 111B rule is a little bit of a smaller case, about half the number of petitioners. No motion to stay that rule was filed. Briefing has not been expedited. First briefs aren't due until July 15th after oral argument takes place in that first case. And oral argument won't take place in this and the B case until next January. So just some of the key litigation issues. I won't get into the detail. I sort of touched on that generation shifting. That's a central issue in that litigation. Does EPA have authority to do that? Can it establish a system that doesn't apply to an individual source? Are those rates achievable by individual sources? Do they have to be? Can EPA regulate a source category under this provision of the Clean Air Act when that category is already regulated under Section 112? Could an argument be made that the rule is coercing and commandeering states? In the B rule, we have some more specific CCS-related arguments. I won't get into those because briefing hasn't started, so we don't know exactly what those arguments will be, but some of these have been discussed already. The Energy Policy Act prohibits EPA from establishing a best system of emission reduction based on projects the U.S. Department of Energy has subsidized. Did EPA do that here? And if so, is its rule then precluded by the Energy Policy Act of 2005? And then the other sort of key issue that's already been discussed is CCS adequately demonstrated for electric generating units in the United States? So what's next? The rules definitely are under a very significant litigation threat. They're vulnerable. Even if they do survive a legal challenge, a whole lot depends on the next president, who could have some role in ensuring whether the rules continue as they're planned to currently under this administration. Many states at the same time continue to act to address climate change, even with the stay and even outside of this Clean Power Plan situation. A number of states have established bans on new fossil generation. There's, of course, a number of renewable portfolio standards and cap and trade programs in a number of states. International agreements are receiving more attention. And then, of course, a number of shareholder and divestment pressures. All of this is placing pressure on coal-fired electric generating units and power plants. So moving.
Thank you very much, Donna, for that very insightful look into the carbon regulatory sphere. Now let's turn it over to Dan on the investment side of things.
You did.
Thank you. This is Dan Aschenbach. May I advance the slide? I wanted to first introduce our panel today on carbon regulation. Randy Artis is with the Director of Wells Fargo Securities. Pat Pope is CEO of Nebraska Public Power District. And Paula Gold-Williams is CEO of San Antonio, interim CEO of San Antonio CPS. The next slide, please. So Moody's outlook for public power electric utilities, as well as much of the U.S. electric industry, is stable. Our outlook period is about 12 months that we look into this year. And the biggest, however, is with regards to obviously carbon and transition to cleaner energy sources. That presents the largest challenge for public power utilities, and also potential opportunities, as was mentioned before, with carbon capture technology, for example. We do expect public power electric utilities and G&T cooperatives that own coal-fired generation, they'll feel the negative effects of the CPP rule, mostly, and could result in credit pressure, particularly in certain regions such as the Midwest and Southeast that has a substantial amount of coal-fired generation owned by public power utilities and cooperatives. Transition to cleaner energy has both cost and reliability issues. Both of these factors are really critical factors in the not only in credit ratings and how we view credit ratings, but also obviously from a customer point of view. The next slide, please. I just listed a few of the questions that we pose. Getting to 33% renewables sources of energy serving retail load in California has had some issues. They're moving ahead. They've gotten to 20%, 33% by 2020, and 50% is the new policy to 2030. And this is the major drive to reduce carbon as well in California. So the question is, how can this be replicated in other areas of the U.S.? When you look at California from a public power utility perspective, Los Angeles, for example, just passed rate increases for the next 5-year period. There are questions still as they move up, as renewables climb, about intermittency and the transmission network and how much additional investment is going to be required as renewables get more pronounced. In Los Angeles' case, they are having to reduce carbon dramatically. They do own coal-fired generation outside of the state, so it just poses the question when you think about how utilities in other regions that are dominant in coal, for example, the Midwest, coal is about 65% of power supply. The gas infrastructure of gas is going to be the next fuel. The ability to transmit renewables, those are some things that we think about and clearly are transitional issues in front of the industry. Over 300 cities in the Midwest invested in upwards of $9 billion in new supercritical coal-fired units that came online after 2011. And those units are new. They're going to be out there for 40 years, and so the question of stranded costs comes up. If the CPP program, for example, requires those units to run less because of the need for that particular state to get more carbon reduction. So it's going to be, the new rule depends on timing of compliance and whether there are other technologies that help to mitigate some of that concern. Another area, carbon neutral new nuclear energy construction in the Southeast is making progress. Reports the other day of Vogtle, the 2 new units of Vogtle are about 60% completed. Obviously the question is, is this a solution for liability and at what capacity cost? That's something that is front and center in looking at those projects. No other new nuclear has been announced at this point in time. And for looking at the power supply plan of public power utilities throughout the U.S., more and more natural gas is filling in now as older coal units are shut down. And the question about fuel diversity becomes more and more of an issue. As an example, in Florida, you can't build a coal plant in Florida any longer, and they're upwards of 60% of natural gas providing power supply. If prices do not hold, Moody's has, for example, a $3 price for the next few years. If events take place that cause that price to go up, that will affect customers. And from a credit perspective, if financial metrics aren't maintained, clearly that could have impact. So despite these challenges, many public power utilities aren't waiting for the new president or a stay to be lifted to forge ahead. And potential advancements that we're hearing about today, which is very interesting to me as well, because I know that the 2 commercial units, CSS commercial units, have not yet made the economic case, but as technology advances, clearly that's something that is to be viewed importantly. So our view is that the Clean Power Program and the reduction in carbon, if it increases policy execution risk, that's something that we're focused on. Today we have representatives of two of the largest public power electric utilities to offer their comments on how these utilities are preparing for the industry transition. Also, we have represented one of the leading investment banks with Wells Fargo with a strong record of public power investment to discuss views on industry developments. So with that, I'm going to turn it over to Paula for her comments.
Thank you, Dan. So I don't have any detailed slides, but I'd like to tell a little bit of information about CPS Energy. And I'll start what sounds like going back, that back in the 1970s, CPS Energy was not diversified in its generation portfolio. We were all gas, and we had really good pricing and contracts, and things were going well, but we ended up in a dispute with our supplier. And it's so serious that there was litigation and issues in the San Antonio market, big headlines. It all got resolved amicably. Actually, a lot of good things happened from that whole instance with the creation of new companies and new agreements and new approaches to business from an economic development side. And then CPS Energy looked at it really hard and said, no more, we are going to make sure that we are diversified, in a diligent manner. So we moved from being 100% gas, and we ventured into coal, nuclear, renewables. We are the largest wind producer, PPA procurer of wind in Texas, and we are substantially invested in solar. So we have a very, very diversified portfolio. But back in 2010, as we started watching all the discussion about what's going to happen with carbon and the carbon tax and the potential for that, what we really recognized, and I don't know, I guess partly it was just being prudent about where this could go and realizing it may not go far, but the real issue was a lack of certainty. And when we saw all the lack of certainty around carbon, we decided that we were going to make a bold move. In reality, we started thinking about putting new environmental controls on one of our plants, DELE units, and we were going to spend $500 million initially, but we just kept thinking that you can't quantify what uncertainty is going to look like in the future, and it would be hard to put a bet that the price of carbon, what direction it was really going to go. So we actually very early on, around the 2011 timeframe, self-elected to deactivate the units. They are not deactivated today, but they're going to deactivate in the 2018 timeframe, which was a huge deal. We have close to 800 megawatts coming off of that plant, and most entities that had the units that would go well into 2030s they were deciding to go ahead and put the environmental controls on there and not deactivate those units in some degree early. But we decided that we'd rather take the funds that we would have spent on the environmental controls and redeploy our strategy in the generation areas. So we made that decision. And in reality, the units are deactivated and can shut down in 2018 and sit, and they can be available for ERCOT to call upon them if they're needed. But for practical purposes, we don't plan to run them after 2018. What we did is we went and took those funds and bought a gas unit that serves in a city close to San Antonio called Seguin. And the units were fairly young, and we are currently using them in our competitive market. Our off-system sales primarily uses that, and we use it for some backup production for CPS Energy. So that was just a huge deal for us to do, and we did it early, and a lot of people didn't understand it, but by now it's really playing out well for us to have already bought the gas units and have them available for taking up the capacity that the coal units will leave when they are deactivated. Additionally, we continue to look for other types of technology. We were the initial off-takers to a clean coal project, Summit project, and that project continues to have interest, and Summit partners continue to work on that one, and potentially that we make it 200 megawatts on that at some time in the future. Right now, our option is not open. The option has expired, and we continue to look at it from a due diligence standpoint. But there are parties out there that continue to invest in clean coal, and I would imagine that there may be some movement in that in the near future. Like I indicated before, we did solar. We are up to 450 megawatts in a utility scale project with a consortium out of South Korea. And that is really helping us on our clean power strategy. We continue to work on other distributed solar and distributed energy projects. We're doing a rooftop solar project and community solar. We continue to support rebates. And we have a huge STEP program. We have 771 megawatts of energy efficiency and demand response. So we still we are watching the coal perspective closely, and one thing I did fail to mention. That said, our older units we had planned to deactivate, but we have Spruce Unit 2 and Spruce 1 that continue to operate. They're newer units, and they have environmental controls on them. We also use low sulfur coal for those units, and right now we believe that we'll be able to get them compliant within the requirements of the clean power plans as it manifests. Of course, again, nobody really knows exactly where it's going to end up. So we are still deploying a strong focus on diversification, not over-leveraging in any particular energy, and just trying to make sure that we are careful in all of the strategies that we are deploying, making sure they're balancing each other, and really just trying to make sure that we can rapidly adapt to the changes, which is tremendously difficult now with so much uncertainty and on the political front.
Okay.
Our approach.
Thank you. I guess, Pat.
Okay. Thank you, Dan. Well, NPPD, quite frankly, has been looking at carbon for many, many years. As I look back in our history, one of the milestones, quite frankly, was a decision that our board made probably 10 or 15 years ago as to Cooper Nuclear Station, whether or not to even keep that plant open. At the time, Cooper was having some issues. Costs were high, reliability was low. But in the end, I do remember one of the key factors that was considered in keeping Cooper running was the fact that it was a carbon-free resource. Today's situation is different at Cooper. It is running well, and we're glad to have it in the portfolio. If you go to the next slide, basically shows a breakdown of where our energy comes from, and today we're about already 46% carbon-free, and that's really based upon the diversification that we have, not only with nuclear in the resource, but certainly Nebraska is a great wind state, from a production standpoint. We do burn a limited amount of natural gas. We have a very high efficiency combined cycle plant. We've got hydro, and of course we've got coal. I think if my memory served me correctly, in the Energy Information Agency's latest year-end report for 2015, I believe Nebraska had the lowest cost on an MMBTU basis of delivered coal in the entire United States. And so while we're certainly wanting to diversify more and looking at diversification, we still see coal as being in our portfolio. To the question of carbon sequestration, for the last several years now, NPPD has been a member of the Energy and Environmental Research Center out of Grand Forks, North Dakota. those folks are very involved in looking at ways of keeping coal a viable option for utilities, certainly carbon capture and sequestration, and we're hoping to be able to do a carbon capture pilot at our largest coal-fired plant out in western Nebraska in the next few years, because we do think there are some opportunities in western Nebraska, western Kansas for selling carbon for enhanced oil recovery, and we believe that would be a great deal for us. As far as the Clean Power Plan goes, certainly I'm going to wait and see what the courts come out with. I am probably in the camp of thinking that there are going to be some significant changes to the rule. We will then have to work our way through the state implementation plan process and even the most fundamental questions of whether to adopt a mass or a rate-based compliance strategy. And we'll be looking to see what the other states and other utilities within the Southwest Power Pool, which we're a member of, select, because we certainly want to take advantage of any credit trading opportunities that are out there. But we've got lots of options, quite frankly. Right now we are in the process of converting one of our smaller coal units to burn hydrogen. We were fortunate to find ourselves a partner that is transforming the way carbon black is manufactured in the world. And you might be asking yourself, gee, what is carbon black? Well, it is a very fundamental building block that's used in many of the products that we have in our offices. 30% of the tires made of carbon black. This company will be using natural gas as a feedstock and electricity to break the natural gas into its elemental components of hydrogen and carbon. They'll take the carbon, we take the hydrogen, and so we're hoping that their business will flourish and they'll be able to expand and provide us with enough hydrogen to convert a second unit. We'll certainly look at gas resources in the future. I have a concern, to be honest with you, that reliability is being challenged to a greater extent than a lot of people realize right now. I think the centralized markets, such as MISO and the Southwest Power Pool, are having their own challenges right now with balancing load and generation. Right now we're in a period of very low load. We have highly variable wind, and we have very low market prices. And so it's really creating a challenge for these entities, and I do fear that somewhere down the road, if we're not careful about valuing capacity and valuing large capacity that has the spinning momentum to carry systems through disturbances, we're going to find ourselves in a very tough situation. We also in Nebraska have some issues. Even if we wanted to burn more gas, we've got some gas infrastructure issues. I think that's not unique across the United States. I have some of my peers in the eastern part of the United States who've traditionally burned coal, and they look at the gas supply infrastructure in their states, and it's simply not there. And so we're going to have to be very careful as we evolve the generation system to make sure that all the pieces are there so that we don't sacrifice two of the basic building blocks that have made the electric system in the United States, quite frankly, the envy of the world, and that's low cost and high reliability. So with that, Dan, I'll turn it back over to you.
Okay, thank you very much. That was very good. Okay, now we're going to turn over to Randy for his comments.
Thanks, Dan, and thank you to Hunton and Williams and Smith's Research and Gradings for hosting this webinar today. You could advance the slide one slide, please, and advance it again, please. Well, I mean, if you think of Wells Fargo Bank and specifically within securities, one of our competencies certainly is energy, both on the commercial and investment banking side. I interact with our institutional investor clients, and from an investment return standpoint, public power performed better than other municipal sectors in 2015, with primary market issuance up 43% year over year. We see investors attracted to the public power space as a defensive strategy, with those investors comfortable with the revenue-backed essential service enterprises managed by independent and capable management teams, as you heard from Pat and Paula previously. So on this chart here, I just show a slide, to depict what's happening with energy prices at the top. We see them as declining and as connected as ever. And then, as I mentioned, what's happening in the primary market issuance as well as investment returns for 2015. Next slide, please. Over the near term, we do expect markets to struggle a bit with the uncertainty surrounding carbon regulation, as you heard earlier, previously discussed here. However, we do expect electricity rates to become more correlated with natural gas prices as carbon is de-emphasized, as coal is de-emphasized for economic reasons as much as regulatory ones. Longer term, integrating and pricing renewable generation, both centralized in nature as well as distributed, will evolve, and its impact on the traditional utility business model we see is also uncertain. Next slide. With all that said, we do see the current operating environment as manageable. Median revenue growth for public power utilities for 2015 was between 3.5% and 4%. Residential electric rates remain affordable, supported by historically cheap natural gas. Demand response and existing efficiency standards, even excluding the Clean Power Plan, are already reducing greenhouse gas emissions. However, we do see slow load growth does bear watching as it potentially impacts top-line growth for utilities. And so this slide just depicts the state of the market and those factors. Next slide. I'm not going to talk much on this slide. I know some of it's going to be covered by future speakers. But I just wanted to highlight what's kind of happened to the generation fleet over the last 10 years. And as you can see, as I mentioned, the de-emphasis of coal in favor of natural gas and renewables, specifically solar for the residential customer base, and of course wind. Next slide. So distributed generation, as we mentioned, does pose some uncertainties to the central utility business model in our view. However, we do think that there are tools available to utility operators to optimize rate structure and to avoid cross subsidies from on-grid utility customers to off-grid customers. We see really a disruption continuum for distributed generation, with the current state depicted in the top left-hand corner of that slide as the least disruptive, and moving to the most disruptive, where you have a significant amount of customers completely off the grid. We do note that distributed generation does require some level of transmission and distribution investment, as the electric grid as it currently is constituted does not easily accommodate two-way power flows. As shown in the upper right-hand corner of the slide, T&D does represent a meaningful portion of electric rate recovery, and that obviously remains critical, as Dan mentioned earlier in his comments. Lastly, of course, no two regions are the same, and so we do note that there are regional differences when it comes to renewable investment and generation. Clearly, California represents the lion's share of solar capacity being added, as you can see in the bottom right-hand corner of this slide, and we expect California to be the first to have off-grid parity within the United States. Next slide. We also note that consumerism is growing amongst utility customers, with people wanting more say over how their electricity gets generated. We note utility pricing mechanisms and structures, along with renewable energy development methods such as community solar, as Paul had mentioned earlier, continue to emerge, and we expect that to continue. Furthermore, we expect demand for green power to continue to grow quickly, of course, a relatively small base. By way of an investment example, the tax-exempt green bond market grew to $3.6 billion last year, and we expect that to continue to grow, especially if there's a more formalized green bond certification program that comes about. So overall, we see the public power market as a steady and defensive investment over the near term, and over the medium to long term, we do see challenges, but we do think they're manageable, particularly if identified and addressed earlier on in the process. As I think you've heard from our previous speakers, a lot of utilities are continuing to do that. So we do think investors will continue to gravitate toward this sector, particularly with the volatility in other municipal sectors, and even if there's higher rates in the offering here. Next slide. So I just wanted to, of course, plug our research. If you would like to get our research, feel free to send me a note, and look forward to answering any questions at the end of the webinar. Thanks. I'll turn it back over to Dan.
Okay, just summarizing, Paula, CEO of CPS, mentioned the importance of fuel diversity and is continuing the utility's focus on low cost and reliability, and to remain flexible, which is a key factor. Pat and NPPD expressed that baseload around the clock and reliable generation is a basic building block of the U.S. electric industry, which is considered to be the strongest in the world. And Randy, searching for the equilibrium, Supreme Court stay increases the uncertainty with regards to CPP implementation, that electricity rates are correlated to gas price increases, and distributed generation does pose a challenge to traditional utilities. So with that, I guess we can move on to the next speaker.
Thank you very much, Dan, Randy, Paula, and Pat. Really excellent and thoughtful perspectives on generation needs and investment. Now I'm going to discuss the generation fleet changes that we are currently seeing and have been seeing for the last several years, but how carbon regulatory changes will factor into that. Next slide, please. The first thing I'd like to say here is that if we're going to meaningfully reduce CO2, we really have to have carbon capture and sequestration and carbon capture utilization and sequestration. That has really been made clear by the Intergovernmental Panel on Climate Change's fifth assessment report, which studied a variety of different scenarios on carbon regulation and found that really under most scenarios you can't hold the world to a 2 C change without CCS, and under the least expensive of the scenarios that did actually get there without CCS, the electricity costs were increased by 138%. Since then, we have the Paris Agreement, which has moved the target from a 2 C change to a 1.5 Celsius change. So really, we expect some additional research which is coming out soon to show that there really is no scenario under which you can really meaningfully reduce CO2 without CCS. So again, the operation of the electric generation system in our country is undergoing fundamental change, not just as a result of carbon regulation, but certainly that is going to add to it tremendously. But one thing we need to keep in mind, reliability is and long has been the absolute irreducible minimum of electric service. Electric service doesn't do you much good if it's not available when you need it. And so it has always been the essential pillar of that service, along with affordability. But now that we are adding in carbon regulation, we've long had to juggle environmental performance as part of providing the service reliably and affordably. But adding carbon regulation is like going from juggling 2 tennis balls to juggling 2 tennis balls in a basketball. The environmental performance now is of such consequence to the operation of the system that it really is threatening to outweigh the other 2 pillars, and that is really causing fundamental change. And what sort of impact is this having on reliability? Well, many on the phone may be familiar with the comments that Nick Akins, the CEO of American Electric Power, made a couple years ago on Capitol Hill in the wake of the polar vortex. But for those who aren't, he said that 89% of the generation the AEP will be retiring in 2015 was called upon during the polar vortex in early 2014 to meet electricity demand in January. That's a fact. He said those units were called upon by PJM and they were relied upon to maintain regional reliability. Next slide, please. Thank you. Let's go back to the previous slide. So also in MISO, the North American Electric Reliability Council's long-term reliability assessment found that MISO's anticipated reserve margin will drop below the reference margin level, which is 14.8%, in 2016, and by 2024 it's expected to decline to 5.23%, which is a very, very thin margin. MISO projects this year that it will operate at the reliability level of approximately 2 days in 10-year loss of load expectation, which increases the likelihood that resources will not be sufficient to serve peak demand. With environmental requirements, we really have to address how do we maintain and replace baseload reliability. We are losing baseload units that I refer to as quote-unquote always-on units that operate almost all of the time. And we are largely replacing them in many areas with intermittent resources. And replacing the baseload reliability is really a key question to the electric sector. Not all generation is created equal. Not only do you have intermittency, but you also have the need to provide things like voltage support, frequency regulation, black start capability. The question of whether you have fuel on site is very important to reliability. All of these are factors that have to be taken into account in coming up with a new replacement generation for the generation that's retiring. Next slide, please. So, what are the factors that have been pressuring coal and other base load toward retirement? And other base load really includes prominently nuclear power, which, as has been mentioned, is a carbon emissions-free resource. Well, carbon regulations are a main factor, but we also have non-carbon environmental regulations like the mercury and air toxic standards, the cross-state air pollution rule, a variety of other rules that have come out of the Environmental Protection Agency. We have, as has been mentioned in previous slides, increasing state renewable mandates. A number of states just within the last year have dramatically increased their renewable requirements in an effort to address climate issues and carbon regulation. We have renewable subsidies that are dramatically affecting the price of energy in a variety of markets, and that adds further pressure to base load that is currently operating. Market rules in some of the market areas may not sufficiently value reliability. Some markets have capacity market structures that are set up to try and provide additional revenue to compensate facilities to keep them in the market to protect reliability. But I would say that many generators are finding, or have told us at least, that they are finding that those payments are not sufficient. And then, of course, we have cheap and probably persistently cheap, at least for some time, natural gas. Next slide, please. So what have we seen so far? Well, the Energy Information Administration predicted a couple of years ago that 60 gigawatts of coal-fired generation would retire between 2012 and 2020 under their reference case. And this projection was before the Clean Power Program, Clean Power Plan. The Institute for Energy Research has found that 72 gigawatts already has or is projected to retire, again, not factoring in the Clean Power Plan. And carbon regulation, of course, strongly reinforces this trend. We already have 168 coal units that are closed or are to be closed, have been announced to be closed within the next couple coming years. And that's just within the last 7 years or so. Next slide, please. In any event, that's a large amount of generation that needs to be replaced. But, and so you would have to think that does have an impact on carbon loading into the atmosphere. But we would argue quite strenuously that environmental regulation and carbon regulation policy is not achieving its goals. CO2 is an emissions issue. CO2 mixes relatively evenly in the atmosphere. Primary energy consumption globally is projected to increase 37% by 2035. This is according to BP's Energy Outlook. The world population during that time increases by 1.6 billion. We have 5 times the population of the United States that's about to join the planet over the next 20 years or so. Even more so, we have 3 billion people by 2050 who are going to be moving into cities, all expecting all the services that come along with living in a city, such as reliable electricity and power and energy, and all the things that are built with it. China alone, from 2005 to 2009, built in new power plants, new coal-fired power plants, the equivalent of the U.S. coal fleet. And from 2010 to 2013, built half again the U.S. coal fleet. And by 2040, China's fleet is expected to be 50% larger than it is today. So while we have retired or announced the retirement of 72 gigawatts of coal-fired generation, globally last year, 84 gigawatts of new coal-fired generation was constructed. And it is predicted that over 1,000 gigawatts of coal-fired generation is planned or under construction on the globe. Almost all of that is India, China, and other parts of Asia. Next slide, please. So that should explain in itself why we need CCS and CCUS. But CCS really is the only technology that is on the horizon. I have the word here, available. I want to make sure that everybody on the phone knows that that is a loaded term in legal parlance. What I mean to say here, it is the only technology that is available to be turned into a technology that can address carbon issues. It is not currently, we argue, and so do our clients, it is not currently a best system of emission reduction that is adequately demonstrated. It needs considerable investment to reach maturity. But we really must have this technology if we are going to address emissions from fossil, which is really the key issue out there. China, India, and other places aren't building these power plants just to have a few years of operation. Those plants are going to be in operation for many years to come. So with CCS today, what is the status? We have today one full-scale power plant operating anywhere in the world. That is a retrofit plant. It's in Canada. It's Boundary Dam Unit 3. It's been in operation for about a year and a half at this point. There was an article just last week in the New York Times describing the performance of the unit largely as not quite what was expected. Now, any technology has bumps and fits and starts along the way, but it is not quite there yet. We also have one full-scale plant that's under construction, a new plant that's Southern Company's Kemper County facility in Mississippi, and we have one retrofit in Texas that is also under construction. But again, this is a key technology, and we're not there yet. Next slide, please. This shows the cost of new generation, and the first bar to look at is the highest bar, and that is advanced coal with CCS. You can see it's the most expensive alternative that is out there, but yet again, if we want to do something meaningful for the environment with respect to climate, it's the only technology that is out there. Policies are needed to mature and decrease the cost of CCS. Next slide, please. Now, this is the last slide. I'd just like to mention real quickly that the National Coal Council did a report last year called Leveling the Playing Field. I had the honor of being the principal author of that report. The report called for a set of incentives to provide policy parity for CCS vis-a-vis renewables. That was the question that was posed from the Secretary of Energy. What would it take to reach policy parity? And we recommended really a menu of incentives, most importantly a contract for differences structure that would include price stabilization support for electricity or CO2 from a facility with CCS. We also recommended such concepts as guaranteed purchase agreements, which is akin to what currently is available under PURPA Section 210, market set-asides, which would be very much like state renewable portfolio standards. Of interest to this group in particular may be private activity bonds, and that is a concept for which legislation was subsequently introduced last fall by Senators Rob Portman of Ohio and Michael Bennett of Colorado. We also recommended production tax credits and clean energy tax credits. So we are working to advance these principles through a group that Mike Moore, who is about to speak, and I are working to arrange, called the Carbon Advance Center. And with that, I will turn it over from Mike, who will present on environmental imperatives and financial opportunities surrounding CCUS.
All right. Well, good afternoon and morning still. Fred and Terry, thank you very much for having me involved with this program. And it's always an honor to be the guy that stands between everybody and what they're going to do for lunch. So I'll try not to linger too long on too many of my slides. Don't let the number of slides push us too far away. Go to the first slide, second slide. So back in November, 90-plus world leaders got together, shook hands, cried, figured out how to take care of this stuff, and agreed in one of their principles to decarbonize all fossil energy by 2050. They went home, and a number of the world leaders got home and sat back and tried to figure out what they'd just done. I mean, it's great that they've done these things. There's a lot of work going on. But one of the things that some people forgot or seem to not pay a lot of attention to, that there's a lot of these countries whose sole wealth of their countries is based on the production and consumption of fossil fuels, either locally or with trade partners. And the idea of decarbonizing something that creates their wealth has created a little bit of a conundrum for a couple of them. I was in a CERAWeek meeting in Houston 4 weeks ago, and Norwegian Energy Minister Tord Lien was asked point blank by Daniel Yergin in front of 3,000 people, the oil and gas and coal community, and said that you were there, you've agreed to do all these things, and yet you produce oil and gas as the wealth of your country. How do you live with your double standard? And he said unequivocally, oil and gas are the wealth of our country. We will produce them because that's what we do. End of story. And so what that means is we're going to decarbonize. Everybody's agreed to do that. And you're going to have a lot of things that you need to do to get that done. Next slide. So on the carbon capture and storage and carbon utilization and storage sector, the Global CCS Institute, it was started by the Australian government half a dozen years ago, has been involved in tracking a lot of the developments globally on managing CO2 emissions from primarily industrial sources and power generation, looking at coal, petcoke, natural gas, and oil as the emission stream sources, primarily power generation, but also keen on the industrial side. And they track the number of projects that are out there in various stages of development, various stages of technology for capturing CO2, whether it's in the process or post-combustion, like one of the projects that Fred had mentioned, and ones that are on the horizon. And so if you look at the chart, look at this slide, what you see is that there are a lot of people, a lot of entities, a lot of places around the globe with a lot of different processes all trying to get to that point where capturing CO2 from these processes can make environmental and economic and commercial sense. So it's not like you have one or twos running around trying to get this done. And there's a lot of projects that have come and gone where the expertise is still out there, but the project itself may not be. Next slide, please. One of the projects Fred mentioned was the project in Mississippi. It's the Mississippi Power Kemper project. It's a proprietary IGCC project, which is important for the region in that it gasifies lignite, not typical coal. It monetizes lignite, which Mississippi has a lot of. Here again, we go back to this regional wealth production, keep it in the mix, and find the technology to make it work. It's not just about making the CO2 available and removing it from the atmosphere. It's also about taking lignite and keeping it as a valuable commodity in the revenue mix for the state of Mississippi. That CO2 will go to enhanced oil recovery and safely stored. Next slide. The NRG Petronova WA Parish Power Plant, just outside the southwest edge of Houston, is building a CCUS project, post-combustion on natural gas-fired generation. The gen sets up. They're building a pipeline from the plant 80 miles southwest to a field owned by Hillcorp that they've partnered with the Japanese Nippon is in there, and a few of the others as their partners, MHI. It, again, is another way of monetizing a regional resource. In the case of Hillcorp's oil field, it was beyond its typical production curve. The CO2 will help boost that. It brings a partner to the project. It brings stakeholders in the process in the region at a federal and a state level as well. And it's also one more step towards finding ways to capture CO2 from power generation and from gas-fired power generation to the next slide, please. Their products in the refining process, you need a lot of hydrogen. There's a process using natural gas that they reform it, steam, and you end up with your hydrogen and CO2 as an output. Part of it, CO2 is ported away to enhanced oil recovery, which, by the way, is an active CO2 EOR project that the CO2 goes to right on the edge of Houston city limits on the southwest edge of town, called the Hastings Field. That's been underway for a couple of years now. Next slide, please. It's the project that CPS had an interest in through that output from the power at one point. Still looking at that as she mentioned, that this particular project is right smack dab in the middle of the, I guess you'd call it the Gold Coast of CO2 EOR in the Permian Basin. You get to go on. Of course, natural gas and its price points have had a big impact on a lot of these projects. Last I heard, that Chinese partners had come in along with some Canadian ones as well, and it's advancing. And then next slide, please. Pat had talked about EERC up in North Dakota. I work real close with the folks up there as well. They've done a lot of work to advance CO2 capture, CO2 EOR, as well as carbon market monetization in a lot of other various mediums as well. But one of the areas up there for them is that they have a lot of lignite. They have the Bakken fields that have a certain amount of production capacity under typical oil production technologies. CO2 could potentially give more life to Bakken shale fields in the future and store CO2. Next slide, please. And in terms of going back to that slide after my first slide, it shows all the different projects in various stages. These are projects that are underway, different parts of the world, a little more detail. All CO2 EOR gives you an idea that this is not, again, one-off type activity. There are large companies, EPC contractors, oil and gas companies, pipeline developers, the whole gamut of folks involved that are able to develop, build, and connect the dots for CCUS for those that want to advance into it. So next slide is placeholder. Go to the next slide. Why, where CO2 EOR? West Texas, we have an ideal area for CO2 EOR. We've been doing this for 40-plus years, a little over 300,000 barrels a day of oil produced specifically by using CO2 to drive oil from mature reservoirs. It's something we've got a lot of infrastructure, a lot of regional expertise, a lot of company expertise to service and develop, and a lot of operational expertise to do this. Next slide, please. We also have up in Wyoming a substantial play going on right now as well. Could take a lot more CO2 up there, but again, we've got regional players that have the expertise to put it in, build the pipes, manage the production process and sequestration. And on that slide to the left is also the arc of the Gulf Coast, where Denbury's primary pipe system extends from Mississippi down into just southwest corner of Houston, moving CO2 to active EOR projects along the way. Very target-rich area for potential CO2 capture, as well target-rich area for CO2 that could be used for EOR and also consequently stored. Next slide, please. So when it comes to CO2 EOR in the U.S., it's not a niche market. There are substantial areas that can be developed. The capacity, make the
Mike, you're cutting out on us.
Uh-oh. Is this any better?
Yes.
All right, great. So if you were to, even if you were to simultaneously capture all the CO2 from all the industrial sources and all the power generation points, you would overwhelm the system. I don't think anybody expects everything to simultaneously go hot. What you do have is you have a lot of opportunities, as we refer to in other industries, low-hanging fruit. People that are in the space first will have the best opportunities, probably the best economic returns for the opportunity to do CO2 EOR, CCUS, with CO2 stored in some of these areas. But even that is a substantially large number. It's measured in the tens of billions of barrels of recoverable oil, consequently the tens of billions of tons of CO2 that could be effectively stored in these sites. Next slide, please. So we have, just like the technology we've developed for capturing CO2, we keep trying to improve its efficiency. Just like the technology to improve the efficiency of drilling times and discovery times for fields to drill and production methodologies for the shale plays. So too are we looking for more ways to do additional work with CO2 enhanced oil recovery. In West Texas and other parts of the world, there is an area called the residual oil zone. It's turned out to be a very massive resource play that I won't go through each one of the individual slides, but just in the Permian Basin alone, this area, this residual oil zone, as it's been well identified over the last few years now, DOE money has paid and funded the research for it. There's been 9 to 10 pilots that have run to proven this up, that the resource for recoverable oil plus a massive amount of storage capacity for CO2 in secure area will double the size of the known capacity of the Permian Basin as we know it today. The catch is the need for CO2. There are really no other ways to produce oil from this reservoir structure that underlies the Permian Basin. These same structures exist in Wyoming. There's 3 basins in Australia that looks like they have the same kind of structures. The massive Garwar field in the Middle East, which the belief is the structure itself extends all the way into the Arabian Gulf. So the capacity, and there might be 2 locations in Europe that they're looking at right now. Notice the size and capacity of CO2 that could be stored, utilized for EOR, and captured is far greater than the IPCC studies came out with a few years ago. Just a heads up on that. Why does all this matter? Next slide, please. And obviously it matters if you want to capture the CO2, but if you're one of those countries that owns that resource, and you're one of those countries who right now, next slide. I'm sorry if I did this together. Next slide. I got ahead of you. Next slide. Next slide. All right. So if you're one of the countries whose wealth is based on hydrocarbons or fossil fuels, and you were at Paris and you agreed to decarbonize your future wealth, and you right now are experiencing what U.S. coal markets experience, that's the slide we're on right now. The publicly held shareholder equity has been decimated by about 98%, 99%. Next slide, please. We've seen natural gas as a commodity price collapse, which in turn has a big impact on all of its other surrounding fossil fuels, as we see what happens with coal-fired generation. But it's also had an impact on pricing LNG, where there should have been a lot of LNG traffic expected because of high value of LNG in demand zones with cheap U.S. LNG to fit them. It doesn't quite work. Next slide, please. And we've seen the same thing happen to crude oil. So we have this trifecta of collapsed pricing on the fossil fuel community. At the same time, the world pledged to decarbonize this same commodity group with its alternative power supply coming from what we see with renewables and alternative energies. What I would wager is that the people that own these resources, that have agreed to decarbonize them, that are feeling the effects of these collapsed commodity prices, are going to go to greater lengths to find ways to keep those fuels in the mix, but also make sure that they're more environmentally sound and effective and efficient in reaching the goals that were achieved, reaching those goals that we set, or the world set in Paris. What does that mean? That means that at the moment we have a bit of an aversion to fossil fuels from some institutional standpoints. But at the end of the day, countries' economies, community economies, regional economies do well when their fuel costs are the cheapest. And I don't think anybody on the phone has to have that point taken home. And so if fossil fuels can be competitive or stay incredibly cheap and have the environmental controls fit to them that's being asked to do and still stay in that band, my guess is you're going to see a lot more interest and activity in how we get that done. And so out of the fear of other markets out there, the IMF came out recently and said if governments don't change the pricing structure for fossil fuels, then the renewables that they've invested into become at risk because the spread becomes too big to carry. You've seen just recently with Sun Edison. So if you go, the slide I left you on there, go to the next slide, that is the IMF slide, talking about them. It's telling governments they've got to change the pricing structure for fossil fuels. And then the last one, of course, folks probably are familiar with what's going on with Sun Edison. Whatever the reasons are for Sun Edison's demise, there'll be a lot of people pointing their finger at very, very, very deep fossil fuels, helping accelerate the situation they found themselves in, whether it's a perception or a mindset. So there's a whole lot of turmoil going on about what all this might mean. But at the end of the day, very valuable resource, a very useful role in society. Technology is being developed all the time to take this to a place where it's commercial, environmentally, and socially acceptable. And there's a strong will by the owners of these commodities to make that happen, as well as there's a strong will of the folks that have embedded assets, still have 20, 30, 40 years of asset value left in them to keep those in play, as well as the need for good, solid, long-term baseload generation to allow us to move these renewable numbers into these that people expect us to do. With that, I'll stop. As I didn't know, I can probably talk all day, and I won't do that to you.
Thank you very much, Mike. That was an excellent presentation, and I'd like to thank our other speakers and panelists. At present, we do not have any questions that I see on the list. If anyone does have questions, please put those in through the chat function. While we're waiting for any, I will ask one of our financial sector participants and our utility participants, what does, in your experience, the financial sector need to see from a project that would incorporate CCUS, as Mike has just described, in order to make a financial decision? I pose that to Dan, Randy, Pat, and Paula.
Anyone want to take that?
Well, I mean, I'll start it off. So this is Paula Williams from CPS Energy. I mean, I absolutely believe from an investor standpoint, we've got to show that the economics still work out. Some of the things that we're talking about, particularly on the carbon capture, it's interesting. I think it's still probably, as we also saw on the slides, one of the most expensive approaches. Our perspective has been then, we won't go as large maybe, but we'll make sure that we can leverage it within the affordability of our customers' bills. And so I still believe that somewhere down the road we'll be looking at some of these items, but we'll still have to prove it out specifically to investors. How do you really make it work in your broader portfolio, not just by itself, but how do you make sure your long-term rate plan can handle it, customers are willing to pay for it, and the economics are solid?
Yeah, this is Randy from Wells Fargo Securities. I would agree with what Paul stated. We've seen in other, whether they're project financed or part of a more traditional financing with a broader generation fleet, kind of commingling these assets, that investors are going to be skeptical of new technologies until they see them in place and in use, and ultimately, investors are going to want to look for the most economic impact. And so, when they see a cost of that technology that's above other technologies, that's going to be something that they're going to be critical of. With that said, and we've seen this even in in storage, battery storage for say electric vehicles or even for broader use, that technology can come down quickly, and so what it looks like today may not be the case 6 months, a year out. So it's always a lens that's viewed currently, though some investors do take a wider lens and sort of want to be first to be the ones to take advantage of that cost curve that may decline.
Yeah, Dan,
Thank
this
you.
is Pat. I think one of the other issues or concerns, and we've certainly looked at CCS as much as anybody with a large, very low-cost coal-fired plant that has conceivably 30 or 40 more years of life in it. But we're going to have to see the investment in the technology because of the challenges not only with the chemistry, I guess, so to speak, but even the house load. When you, if you look at putting one of these systems on, it's not a small ancillary load that you're adding to your unit. It is very significant. That drives up the megawatt-hour cost out of that unit. And again, as I said earlier, you're going to be comparing that with every other option you've got.
Thank you all very much. We have two other questions that have come in. One is to Tana. What is the timetable for the Supreme Court to rule on the litigation that is out there affecting the Clean Power Plant? Of course, it's in the D.C. Circuit right now, but how long do you think it would take for that to migrate to the Supreme Court and get a decision, and what do you think is the likely outcome?
So as I noted earlier, the oral argument on the Clean Power Plan litigation is taking place in the U.S. Court of Appeals for the D.C. Circuit on June 2nd and possibly June 3rd. The court set aside 2 days in case the parties and the judges thought it was necessary. So I would think the quickest the court would come out with a decision at the D.C. Circuit level would be the end of the summer, probably more like early fall. At that point, there are a few months during which the losing party would file a petition for a writ of certiorari with the Supreme Court. Then there's a response. Then the court will decide whether or not to take it. It's not a sure bet that it would take the case. If it does, it's likely, I think, the soonest it could hear it, I think, would be late spring of 2017. And so I think the earliest we would see a decision out of the court would be the fall of 2017. I think that's about right. It could go longer than that, though. An outcome, who knows? A whole lot depends on what happens with that ninth justice. So I think in the 4 days between when the stay was issued and when Justice Scalia passed away, petitioners were incredibly optimistic about their chances. One of the things that the Supreme Court had to determine in issuing the stay was that there was a substantial likelihood that the rule was vulnerable on the merits. And so that was a huge signal from at least 5 justices that they viewed the rule as being very vulnerable. Of course, we've lost one of those 5 justices, and so a lot will depend on who gets appointed and confirmed ultimately to the court. So,
thanks, Donna. We have one last question, and then we will wrap up. And that question is posed to me, which is, what is the likelihood that some private activity bond legislation might be enacted next year? I had mentioned S-2305, the Portman-Bennett bill. It is very unlikely that legislation will be enacted this year, just because this is a presidential election year. We've got, as a result of that, a very shortened congressional schedule. I don't think that a major tax bill is likely to, at least a very large tax bill is likely to move. But in the next Congress, there is a strong bipartisan interest in having broad tax reform. And, that tax reform is a bigger issue than this conference covers, but legislation such as S-2305, which has a very low score from the Congressional Budget Office in terms of its impact on the federal budget, would have an opportunity, I think, if there is some federal tax legislation that moves next year. So I think a decent possibility, and it's something that people who are interested, if people are interested in it, they should be advocating for it to be part of a larger package in the next Congress. With that, we'd like to thank everyone for participating and thank you for these questions. As a reminder, we will be circulating a recording of today's event. And thank you again. Have a